Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. So today we are going to discuss the 5 notifications of the Reserve Bank of India, or we can say the 4 notifications that the RBI has released regarding the REITs, as well as one press release of the Reserve Bank of India. So this is your Finance 360-degree session in which we cover the RBI press releases, the RBI notifications, the RBI reports, as well as we cover the finance current affairs. Okay, so today we are going to discuss the press release of the RBI and the recently released notifications of the Reserve Bank of India. So we will discuss about the supervisory data quality index for scheduled commercial banks that has been released on June 19, 2026. Then we will discuss the different directions that are related to the lending by the commercial banks to the REITs, as well as the directions that have been amended for the InvITs also. So all of this we are going to discuss in today's session. So this session is going to be very, very important for all of you. So give me a thumbs up first of all if I'm clearly audible and the screen is clearly visible to all of you. And hello everyone, good morning. Okay, so everything seems to be fine from my end. Now let's get started with today's Finance 360-degree session, and you will get the PDF of this session in the Telegram channel of EduTap. Okay, so you will get the PDF of the session in the Telegram channel of EduTap. So starting with the first article, that is Supervisory Data Quality Index for the Scheduled Commercial Bank, March 2026. This is released on June 19th. And see, the Supervisory Data Quality Index, previously it was released on the yearly basis, on the annual basis, but now RBI has decided to release it on the quarterly basis. Okay. So now the Reserve Bank of India has created a Supervisory Data Quality Index. Here you can understand that the RBI, through the Supervisory Data Quality Index, checks the data quality of the supervisory data. Okay, the data quality is checked. The data quality is checked for the data that is submitted by the banks to the RBI. So the Reserve Bank of India has created a Supervisory Data Quality Index that measures the data quality in terms of accuracy, timeliness, completeness, and consistency. So remember that these 4 are the parameters under the Supervisory Data Quality Index, and the RBI checks or measures the data quality on the basis of the accuracy of the data, the timeliness in which the data is submitted, the completeness of the data, and the consistency in the submission of the returns and microdata for the supervisory assessments. Okay, the Supervisory Data Quality Index for the Scheduled Commercial Bank cover 87 scheduled commercial banks and their key returns. Now, the RBI has now published the Supervisory Data Quality Index for the scheduled commercial banks for March 2026. And here, what has happened that the data quality has actually, as per the Supervisory Data Quality Index, it has reduced. The Supervisory Data Quality Index, it has reduced from December 2025 to March 2026 for the scheduled commercial bank. So for the scheduled commercial bank, the Supervisory Data Quality Index score was 90.9, which has reduced slightly to 90.7. Okay, so there is the slight reduction that we have seen in the Supervisory Data Quality Index from 90.9 to 90.7. Here, what you have to remember, the 4 parameters of the Supervisory Data Quality Index, that is accuracy, timeliness, completeness, and consistency. And for the March 2026, the Supervisory Data Quality Index has reduced to 90.7. That is the idea. Now, for public sector banks, private sector banks, foreign banks, small finance banks, for all these, the Supervisory Data Quality Index is also released, and the maximum Supervisory Data Quality Index is for the foreign banks. Okay, that's it. Now, why there is the reduction in the Supervisory Data Quality Index? It is because of timeliness and accuracy, which have slightly reduced from December 2025 to March 2026, while the consistency and the completeness have improved. Okay, so consistency and completeness, these parameters, they have improved, but the accuracy and the timeliness, these parameters have reduced. So this is the idea. Now, the distribution of the overall Supervisory Data Quality Index scores. So here you can see that there are 3 banks now. There are 3 banks now that are under the that are in the orange criteria, that is between 70 and 80, that is they need improvement. The rest of the banks, the 30 banks, they are in the acceptable range, and the 54 banks, they are in the good range for the Supervisory Data Quality Index. But 3 banks out of the 87 scheduled commercial banks, the 3 banks, they need to focus on the improvement. Okay, so this is the idea as per the March data. So for the March 2026, the Supervisory Data Quality Index has reduced from 90.9 to 90.7. So this is for the March 2026. So this is regarding the supervisory data quality index. I hope this is very much clear. Basic idea was there. Now coming to the next article, that is the statement on developmental and regulatory policies in February 6, 2026. So this statement on developmental and regulatory policy document was released by the Reserve Bank of India in Feb 2026, in which it was announced that for the REITs, the directions will be released. Okay, so for the real estate investment trust as well as for the InvITs, first of all, the REITs and InvITs, they were conceptualized in India with a view to free up the bank's funds in completed and operational real estate and infrastructure projects. So real estate investment trust, they are the investment trust that collect the funds from the institutional investors, from the retail investors, and this money is invested in the real estate projects. Whatever returns are earned from the real estate projects that are provided to the investors after deducting a fee by the REITs. Okay. Similarly, the InvITs, they are the infrastructure investment trusts. They collect the money from the institutional investors, from the retail investors. They pool in the funds, and this money is invested in the infrastructure projects. Whatever cash flows are coming from the infrastructure project, that is provided as returns to the investors after deducting a fee, basically. Okay. So this is the idea. So REITs and InvITs, the REITs and InvITs, they were conceptualized in India with a view to free up the bank's funds in completed and operational real estate and infrastructure projects by refinancing such exposure through the investors, by taking the funds from the investors, so that the banks do not have to provide the loans for the real estate projects that are completed. The banks do not have to provide the loans for the infrastructure projects that are completed. So REITs and InvITs, they were conceptualized in India with a view to free up the bank's fund in completed and operational real estate and infrastructure projects by refinancing such exposures through the investors. Consistent with these objectives, the commercial banks, they were not permitted initially to lend to these entities. So initially, the commercial banks, they were not permitted to lend to REITs or InvITs, but later on it was decided that the commercial banks, they can lend to the InvITs. The commercial banks, including the small finance banks as well as the all India financial institutions, it was agreed later on that these institutions, they can lend to InvITs. Okay, so while bank lending to InvITs, the bank was allowed to lend to InvITs. This was allowed subsequently. Lending to REITs was not permitted. Till February 2026, the lending to REITs was not permitted. Upon review and considering the presence of strong regulatory and governance framework for the REITs also, now RBI is proposing to permit the commercial banks to extend finance to REITs also, subject to appropriate prudential safeguards. And whatever appropriate prudential safeguards will be taken for the REITs, the same safeguards have also been announced for the InvITs. Okay, so this is the idea that for the REITs, it was not allowed. The commercial bank lending was not allowed, while for the InvITs, the commercial banks, including the small finance banks, as well as all India financial institutions, they were allowed to lend to the InvITs for the infrastructure project, because for the infrastructure project, there are more funds that are required. So commercial banks, including small finance bank, all India financial institution, they were allowed to lend to InvITs. Now it has been said that in Feb 2026, in the Statement on Developmental and Regulatory Policy document, it was said that the commercial bank will also be allowed to lend to the REITs, and in Feb 2026 only the draft directions were released, and now in June 2026 the final directions have been released that we will discuss. Now the commercial banks, they are allowed to lend to the REITs, and there are prudential safeguards that have to be taken for the lending to the REITs by the commercial banks, as well as these same prudential safeguards will be applicable on the InvITs also. So this is the idea. So the RBI has now proposed to permit commercial banks to extend finance to REITs. At the same time, existing guidelines in respect of lending to InvITs has also been harmonized, has also been updated for parity with prudential safeguards proposed for lending to REITs. This is the idea. Now the provision on REIT applies solely to commercial banks. That is, it is only the commercial banks that can lend to REIT. Okay, it is only the commercial bank that can lend for the real estate investment trust, while the provisions on InvIT applies to commercial banks, including the small finance banks. Okay, these directions shall come into force from October 1st, 2026. or on earlier date when adopted by a bank in entirety. So the banks can lend to the REITs but with prudential safeguards. That is the idea. Now, key highlights of the amendment and regulations. Lending to REITs or InvITs. Lending to REITs or InvITs. The bank shall be permitted to lend to REITs or InvITs which are registered with and regulated by SEBI, so that there are prudential guidelines that REITs and InvITs are following, and they are registered and regulated by SEBI. A bank may lend only to REIT and InvIT which satisfies the following condition. First of all, the REIT or InvIT is listed. Second, the REIT or InvIT has at least 80% of its underlying assets generating positive cash flows. So basically, the second condition states that the REIT, that is the Real Estate Investment Trust, should have at least 80% of its underlying assets in the real estate projects that are generating positive cash flows from operations for a period of not less than 1 year. So the real estate project must be operating and generating the positive cash flows for a period not less than 1 year, at least 80% of the underlying assets. For the InvITs, at least 80% of the underlying assets for the InvITs. For the InvITs, at least 80% of the underlying assets must be invested in the completed and revenue generated projects. Okay, so InvIT should have at least 80% of its underlying assets in the completed and revenue generating projects generating positive cash flows from operations for a period of not less than 1 year. So this is the idea. 80% is a very, very important percentage that you have to remember, that REIT or InvIT, they can get the funding from the commercial bank only when they have at least 80% of their underlying asset generating positive cash flows from operations for at least a period of not less than 1 year. Now, general conditions. The bank shall ensure that lending to a REIT or InvIT is not used to fund its special purpose vehicles. So think about it, that the REIT or InvITs, they have to invest in multiple commercial real estate projects, residential real estate projects, multiple infrastructure projects, different kind of infrastructure projects. So they create a special purpose vehicle, that is a kind of subsidiary. For the REIT or InvIT, they create a SPV, and through that SPV they are investing in a particular real estate project or infrastructure project. They are creating another SPV, another special purpose vehicle, another subsidiary to invest in another project or the bundle of projects. They create another SPV to invest in another project, so that the losses are restricted to that particular SPV only, to that particular project only. Okay, and the losses are not going through to the other projects. So that is the idea, that they create the different SPVs to invest in different projects or the bundle of projects. So a bank shall ensure that lending to a REIT or InvIT, if the bank is lending to a REIT or InvIT, this money should not be used to fund the special purpose vehicles that have existing loan from the same regulated entity and which are facing financial difficulty. So basically, if a bank is lending to REIT or InvIT, it has to be taken care of that this money is not used by the SPV, or this money is not flowing to the SPV that already has the funds or that already has the loan taken from the bank. And this SPV, it is, if it is under the financial stressful condition, or it is under the financial difficulty. Because think about it, that if the REIT or InvIT is taking the funds to provide the funds to the SPV that has already taken the funds from the bank, so this is a kind of evergreening of loan that is happening, that the SPV has taken the loan from the bank. Now the SPV is taking the funds from the REITs and InvITs taken from this bank to return the loan of the bank. So this is a circular flow that is going on, that bank is providing the loan to the SPV. Now bank is providing the loan to the REIT or InvIT so that the SPV can return its loan. And the SPV is also under the financial difficulty. So if the loan is meant, so this is not allowed. The bank shall ensure that lending to a REIT or InvIT is not used to fund its SPV having existing loan from the regulated entity and which are facing financial difficulty. If the loan is meant to refinance the existing loans of the special purpose vehicles, such refinancing have to be announced clearly beforehand, has to be clearly stated out beforehand, and can be done only for the completed projects that have received a completion certificate, occupancy certificate, or any equivalent approval for the REITs. And the commencement of commercial operations, this kind of like for the InvITs, there is the commencement of commercial operation that has happened for the InvITs. Okay, so this is the idea, that even if the money is taken for the refinance, it has to be clearly stated, and it can only be taken for the completed projects that have the approvals. Okay. Now, if a bank gives a loan to REIT or InvIT, the bank should avoid bullet repayment. Bullet repayment means that, let's say, the interest is paid for the whole of the tenure, but the principal amount will be paid at the end of the tenure in one go. So this is bullet repayment, that the interest is paid for the whole loan tenure every month, but the principal payment will happen. The principal payment will happen at the end of the loan in one go, in one payment. Or let's say for the whole of the tenure of the loan, there is no interest payment, there is no principal payment. At the end of the loan only, in the bullet, in one go, the principal and the interest payment will happen. Ballooning repayments basically means that in the whole loan tenure, in the complete loan tenure, the interest was paid as well as a very small amount of principal payment was paid, and at the end of the loan tenure, the rest of the principal payment, that is the major chunk of the principal payment, will be paid. So if a bank gives loan to REITs or InvITs, the bank should avoid the bullet repayment or the ballooning repayment structure, because here the bank is having a disproportionate portion. Under the bullet repayment or under the ballooning repayment, there is a disproportionate portion. There is a large portion of the principal repayment that is not concentrated in the terminal phase of the loan tenure. It is the large portion of the principal payment. This is paid at the end of the loan tenure, which is more risky. So that's why the RBI is saying that if the bank is giving loan to the REIT or InvIT, the bank should avoid the bullet repayment. The bank should avoid the ballooning repayment, where a major chunk of principal repayment happens at the end of the loan tenure in one go, so that there is not a disproportionate portion that is for the end. That should not happen. Okay, so the bank should avoid bullet repayment or ballooning repayment for the loan. But it has been said that the bank can provide, or the bank can invest in the debt instruments of the REIT or InvIT, and these debt instruments, these financial instruments, they can have the bullet repayment or ballooning repayment structure. So the restriction on avoiding bullet or ballooning repayment structures applies when the bank is giving a loan or direct credit facility to a REIT or InvIT. In this case, if the bank is giving the loan, then the repayment cannot be in the bullet repayment form or ballooning repayment form. But if the bank is not giving direct loan and is instead investing in the financial instruments, the debt instruments of the REIT or InvIT, such as the bonds, debentures, commercial paper, then this specific restriction does not apply. Okay. So if the bank is giving the loan, then there is the restriction. There cannot be bullet repayment or there cannot be ballooning repayment. But if the bank is giving the money for the investment in financial instruments, then the bullet repayment or the ballooning repayment can happen. If a REIT or InvIT takes finance from commercial banks for acquiring stake in other entities. So I hope you remember about the acquisition finance. Anyone that has the idea about the acquisition finance? See, under the acquisition finance, what happens that the banks, they provide loans, or they provide the finance to the acquirer company to acquire the target company, to acquire the major shareholding or the major control or the control in the target company. Okay, so banks are providing the loans or the finance to the acquiring company to acquire the major shareholding or to acquire the control over the target company, that is the idea. So if a REIT or InvIT takes loan from commercial banks for acquiring stake in other entities, including SPVs or holding companies, the loan will be governed not only by the REIT or InvIT lending norms, but also by the rules on acquisition finance. So first of all, it has been clearly stated that the bank, so here it has been clearly stated that the bank can provide the loan to the REITs and InvITs for the acquisition finance also. Okay, so bank can provide the loans to the REITs and InvITs for the acquisition finance, so that they can acquire another entity, they can acquire the other entity, or they can acquire the SPVs or holding companies. Okay, so acquisition finance can be provided to the REITs and InvITs. One important point to note is that in case of small finance bank cannot provide the acquisition finance. So small finance bank cannot provide the acquisition finance to the InvITs. So the commercial banks, they provide the loan to the REITs, while the commercial bank, including the small finance bank, they provide the loan to the small finance bank. To the InvITs. Okay. So commercial bank provide the loan to the REITs, while the commercial bank, including the small finance bank, provide the loan to the InvITs. But it has been clearly laid down that the small finance bank cannot provide the acquisition finance to the InvITs. So banks can provide the loan, can provide the finance to the REITs or InvITs for the acquisition finance, the commercial banks basically. If the borrower is a REIT or InvIT, even though they have the financial structure, but basically, if the borrower, that is a REIT or InvIT, it will not be denied acquisition finance merely because it is not a non-financial company. So usually the acquisition finance is provided to the non-financial company, that is the acquiring company that wants to acquire the target company, that is also the non-financial company. Okay, so acquisition finance is for the non-financial companies, but here it has been said that because the REIT and InvITs, they are the trust, they have the structure as the trust or the investment vehicles, so they are not a purely non-financial company, but still they can be provided with the acquisition finance. So if the borrower is a REIT or InvIT, it will not be denied acquisition finance merely because it is not a non-financial company. Okay, so basically REITs or InvITs, they shall be exempted from the requirement that the acquiring entity shall be a non-financial company. That is the idea. While extended acquisition finance to REIT or InvIT, some general conditions will not apply for the acquisition finance, like we have just discussed, that they shall be exempted from the requirement of the acquiring company being the non-financial company. Okay, while extending acquisition finance to a REIT or InvIT, some general conditions will not apply from the acquisition finance, including the requirement related to net profit after tax. So basically, the REIT or InvIT, they are exempted from the requirement of the non-financial company. Even if they are the financial company, still the REIT or InvIT can take the acquisition finance, as well as they are exempted from the requirement of net profit after tax for the previous 3 consecutive financial years. So usually the acquiring company must have net profit after tax in each of the previous 3 consecutive financial year, but for the REIT or InvIT, that is the acquiring company, they are exempted from this requirement also. They have this relaxation that they do not need to have the net profit after tax in the past 3 consecutive financial years. Okay, now prudential ceiling on the leverage. So the total exposure of all banks to a borrowing REIT or InvIT together, think about this, here we are talking about the aggregate exposure of all the banks to a borrowing REIT or InvIT. That means, let's say multiple banks, it's lagging, or it's fine? Can anyone confirm? It's fine now. In your, okay, chalo, let's continue. Prudential ceiling on leverage. So the total exposure of all banks, let's say multiple banks are giving loan to the REIT or InvIT. Okay, so the total exposure by all the banks combined, okay, the total exposure of all the banks combined to a borrowing REIT or InvIT together with its underlying SPVs holding companies shall not exceed 49% of the value of the REITs or InvITs assets, or such lower limit as may be decided by the bank's board. So the total exposure of all the banks to a borrowing REIT or to a borrowing InvIT together with the lending that has happened to the SPVs or to the holding company shall not exceed 49% of the value of the REITs or InvITs asset. Let's say the REIT, including its SPV, including its holding companies, have the total asset value of 100 crores. So all the banks combined, they can maximum provide 49 crores as the loan to the REIT. Okay? So that is the total exposure limit for the whole of the banking system. That is 49% of the value of the REITs or InvITs assets. Now security coverage. So basically, if the banks are providing loans to the REITs or InvITs, the banks will also take what? The banks will take collateral. So if the bank is providing loan, let's say the bank is providing loan to REIT for a particular project. So the real estate project for which the bank has provided the finance, for which the bank has provided the loan, this real estate project will become the collateral to the bank, right? So this is the idea that if the bank is providing, let's say the bank is providing the housing loan to X person, so the house for which the loan is taken will become the collateral. Similarly, if the bank is providing the loan to the real estate investment trust, so this real estate project will become the collateral. Or if the bank is providing loan to InvIT, so this infrastructure project will become the collateral. So if the bank is financing to a REIT or InvIT, it shall be fully secured. The bank shall be fully secured by the right over the underlying immovable property. It can be the real estate under the real estate project, it can be the infrastructure under the infrastructure project. Okay, so bank financing to a REIT or InvIT shall be fully secured by the right over the underlying immovable property. An assignment of cash flows and receivables, like from the infrastructure project, real estate project, whatever cash flows, receivables are coming, so for that should be used to pay to the bank also the regular interest and the principal payments. A pledge of equity interest. Now what happens that sometimes, see, the REIT or InvIT, they do not invest in a project directly. They invest through the special purpose vehicle. So the bank should have the right over this SPV also. Okay. So the bank, if it is providing the loan, if the bank is providing the loan to the REIT or InvIT to invest in the project, and the investment is happening through the special purpose vehicle, so the bank should have a pledge of equity interest held by the REIT or InvIT in the relevant SPV, because when the bank will have the right over the SPV, then only the bank can have the right over the project. So the bank should have the right over the immovable property, as well as the bank should have the right over the SPV, so that the bank can get this immovable property in case the default happens. I hope this is clear. Okay. So security coverage, the bank financing to REIT or InvIT should be fully secured by the right over the underlying immovable property, an assignment of cash flows or receivables, a pledge of equity interest held by the REIT or InvIT in the relevant SPV, or such other legally enforceable security interest as may be applicable. Where a right is created over immovable property, it shall be invariably be in the nature of exclusive first charge. That means the bank should get the right over this project as the first charge, that the bank will have the first right. If the REIT or InvIT defaults, then the bank will have the first right over the underlying project, over the underlying immovable property. Let's say that multiple banks are providing loan to a REIT or InvIT for a particular project, for a particular immovable property. Now in this case, if the multiple lenders are involved, then there will be first pari passu charge. Pari passu charge means, let's say a lender has provided 30% of the loan, another lender has provided the 30% of the total amount, another lender has provided 40%. So on the basis of how much you have provided the loan from the collateral, the same percentage of the money will be returned. So let's say one lender has provided 30%, another lender has provided 30%, another lender has provided 40% of the total loan amount in case of the multiple lenders. So when the collateral is sold, so this collateral, like if it is sold, whatever amount is retrieved from that, 30% will be provided to the first lender, 30% to the another second lender, and 40% of the amount to the third lender. So this is the first pari passu charge. That means there is no hierarchy. On the basis of how much percentage of loan you have provided, the same collateral percentage you will get. Okay, so that is the idea where multiple lenders are involved. So this is the idea regarding the security coverage, that if loan is provided to the REIT or InvIT, it should be fully secured. The bank should have the right over the immovable property, and the bank should have the exclusive first right. In case there are multiple lenders, there should be first pari passu charge. That means on the basis of percentage you have provided, you will get the right over the collateral. That is the idea. Now provided that for the REIT, specifically for the REIT, a charge, that is the right over the underlying immovable property, shall be mandatory wherever financing is extended for the purpose of acquisition or the development of the property or refinancing of debt and such. Okay. Now coming to the last point from this direction, any confusion, anyone? Any confusion? So lending to REITs, lending to real estate investment trust, undertaken by overseas branches of Indian banks. Okay. So lending to REITs undertaken by overseas branches of Indian banks as part of syndication arrangement where multiple lenders are lending to the REIT and such. So lending to REITs particularly undertaken by the overseas branches of the Indian banks as part of the syndication arrangement shall not be subject to the above limits. Shall not be subject to the above limits that we have discussed if the funding contribution of the bank under the syndication arrangement for a particular deal across all of its overseas branches does not exceed 20% of the total funding under the deal. So basically the idea is that if the overseas branch of the Indian bank, under the syndication arrangement where there are multiple lenders is providing the loan to the REIT and the loan amount is equal to or less than 20%, that is not exceeding 20% of the total loan amount. So the overseas branch of the Indian bank is lending to REIT in the syndication arrangement, and the lending of the bank to the REIT is not exceeding 20%. In this case, the above directions will not apply to the overseas branches. In this case, the above directions will not apply to overseas branches. But if the overseas branches under the syndication arrangement is lending more to the REITs, more than 20%, exceeding 20%, then the above directions will be applicable. This is the idea. The bank shall ensure, the Indian banks having overseas branches should ensure that the REIT being funded is registered with and regulated by a financial sector regulator in the relevant jurisdiction and is listed. That is the idea. Chalo. So we have discussed now in the RBI EduTap document that is provided in the course. There is also this infographic that is provided so that you can see the important points and you can remember. And through this infographic, you can revise in a very limited time. So eligibility criteria for the investment in REIT or InvIT for the lending or for the exposure in REIT or InvIT, listing requirement as well as cash flow requirement, at least 80% of the underlying assets must generate positive operational cash flows for not less than 1 year. Then end use restrictions, where the loan can be used as well as refinancing. Okay, so all of this we have discussed. You can use this infographic for the revision and seeing the important percentages. Maximum exposure limit for the whole of the banking system cumulatively is 49% of the value of the REIT asset. Okay, chalo. And special provisions for acquisition finance. Small finance bank first of all cannot provide the acquisition finance to the InvITs. REITs or InvITs are eligible for the acquisition finance even if they are not non-financial companies. The requirement of net profit after tax in each of the previous 3 consecutive financial years do not apply to the REITs or InvITs taking the acquisition finance. Now coming to the next direction. It was not stated in the directions. That means it is as per the board approval or as per the board policy of the bank. Okay. Chalo. Now coming to the next direction. So Reserve Bank of India Commercial Banks Concentration Risk Management 3rd Amendment Directions 2026. Under this, it has been said that as per RBI's Commercial Bank Concentration Risk Management 3rd Amendment Direction, a bank shall fix internal limits. A bank shall fix internal limit for the total exposure, for the aggregate exposure to the real estate sector. So how the bank has to fix, the board of the bank basically have to fix the internal limit for the total exposure to the real estate sector, Okay. The sub limit for a bank's aggregate exposure. Now under the total exposure to the real estate sector, there is a sub limit for a bank's exposure towards real estate investment trust. This shall be subject to a prudential ceiling of 10% of the bank's eligible capital base. So basically it has been said that the bank can decide the internal limit for the total exposure, for the aggregate exposure for the real estate sector. But when it comes to the aggregate exposure towards REITs, so under the investment limit, under the exposure limit, under the exposure limit of the bank, under the exposure limit of the bank for the real estate sector, the bank can decide the internal limit. Okay, under this there is a sublimit, that is the bank's aggregate exposure towards REITs shall be subject to prudential ceiling of 10% of the bank's capital eligible base. Okay, eligible capital base. So this is the idea. This is it for the second direction. Okay, where it has been clearly said that the bank can decide the internal limit for the total exposure for the aggregate exposure to the real estate sector. Okay, but under this real estate sector, if the aggregate exposure is to the REITs, then the maximum exposure can be 10%. The maximum, the ceiling is 10% of the bank's eligible capital base. And the commencement of the direction will be from October 1, 2026 regarding the REITs. Chalo. I will take the extra queries at the end of the session. Okay. Now, next direction is regarding the prudential norms and capital adequacy amendment directions. So this is also regarding the REITs, that exposure to REITs shall be treated as commercial real estate. So whenever the loan is given to real estate investment trust, this shall be treated as commercial real estate exposures and shall attract a risk weight of 100%. Okay, so normally when the loan is given to the real estate investment trust, this shall be treated as the commercial real estate exposure, risk weight will be 100%. However, if such exposures qualify as capital market exposure, that is the investment in the financial instrument of the REIT, the investment is happening in the, or the exposure is to the financial instrument of the REIT. So this is the capital market exposure. The applicable risk weight will be 125%. Lending to REITs undertaken by overseas branches of an Indian bank shall attract a risk weight of 150%. So lending to REITs undertaken by the overseas branches of an Indian bank shall attract a risk weight of 150%. Now I also told you that the All India Financial Institution, they can also lend to the InvITs, right? So for that, there is separate guidelines that have been released, but the guidelines are, the basic structure is same, that whatever directions we have discussed, that in case of InvITs, there are prudential norms that have to be followed. All India Financial Institution may lend to only to InvIT if they fulfill these directions. That is, InvIT is listed, InvIT has at least 80% of the value in the assets which are completed revenue generating, and they are generating positive cash flows from operation for a period of not less than 1 year. They should not like the InvITs, they should avoid bullet repayment or ballooning repayment structure for the loan given to the All India Financial Institution IFI. They should avoid bullet repayment or ballooning repayment structures for the loans that are given to the REITs or InvITs. But if the IFI is investing in the financial instrument of REIT or InvIT, then these bullet repayment or ballooning repayment can happen. Okay, so IFI, if it is giving loan to the REIT or InvIT, then there should be the avoidance of bullet repayment or ballooning repayment. But if the IFI, it is investing in the financial instrument of the REIT or InvIT, then the ballooning repayment or the bullet repayment can happen. Okay, now there are some specific provision for the acquisition finance to InvITs. Now All India Financial Institution can also provide the acquisition finance to InvITs. Now here there are certain additional guidelines that we have to discuss, then this session will be done. Okay, chalo. Now what are the specific provisions that we have to discuss? So all the other directions are same, just in the specific provisions, let's get the clarity. So under the specific provision for acquisition finance to InvITs, an IFI, first of all, it has been stated that the All India Financial, the IFI, it can provide the acquisition finance, it can provide the loan to the REIT or InvIT to that is the acquiring company, to acquire the target company, Here also it has been said that the REIT or InvIT, usually for the acquisition finance, the company should be a non-financial company. Okay, for the acquisition finance, the acquiring company must be a non-financial company. But in the case of the InvIT, the IFI can provide the acquisition finance only to InvITs. Okay. That's why there are separate conditions or there are separate directions. The IFE can provide the acquisition finance, or IFE can provide the loan to the InvITs only. IFE can provide the acquisition finance to InvITs only. Okay. So IFE, it can provide the loan to InvITs, that is the acquisition finance to acquire the target company. So InvIT is the acquiring company that is taking the loan to acquire the target company. Now acquisition finance can be provided to the InvIT that is not fulfilling the non-financial company criteria. So acquisition finance are only provided to acquiring company that fulfill the non-financial company criteria, but InvIT is not a non-financial company, still it is getting the acquisition finance from IFE. That is the idea. So if acquisition finance is being extended to the InvIT, it may be used for acquiring control over the target company. Okay. So now the acquisition finance, we have understood that the IFE can provide the acquisition finance, the loan to the InvIT to acquire the target company. InvIT is not a non-financial company, but it is still getting the acquisition finance. Now InvIT can take the acquisition finance for two reasons. InvIT can take the acquisition finance for two reasons: to acquire the control over the target company, that is to get 10% or more than 10% of the shares in the target company, or to expand the control, that is, let's say the if an acquiring company already holds control, if the InvIT already holds control over the target company prior to seeking acquisition finance, before seeking acquisition finance, the InvIT already has the control over the target company, has more than 10% of the shares in the target company. But now the InvIT is taking the acquisition finance to expand its control to cross the substantial threshold of 26% of the shareholding of the control, 51% of the voting shares, 75% or 90% of the voting rights. So this is the idea that acquisition finance can be taken by InvIT from the IFE for two reasons. One, to get the control over the target company, to get a good voting share in the target company, that is 10% or more than 10%. Or to expand its control, over the target company to take substantial, cross the substantial threshold of 26%, 51%, 75% or 90% of voting rights. This is the idea. So for these two reasons, the IFE can provide the acquisition finance to the InvITs. Now, such acquiring company shall have a standalone as well as consolidated minimum net worth of 500 crore. So if the acquiring company, that is the InvIT, is taking the acquisition finance, it must have a standalone as well as consolidated minimum net worth of 500 crore. Acquisition finance can be extended to the acquiring company for acquisition of target company directly by it, or to see, basically the acquisition finance can be taken by the InvIT to acquire the target company directly, or to acquire the target company through the SPV or through the holding company. So the acquisition finance can be taken by the InvIT to acquire the target company directly, or to acquire the target company through its SPV or through the holding company. That is the idea. So this is the idea that acquisition finance can be extended to the acquiring company, to the InvIT, for acquisition of target company directly by it, or acquiring company for on lending to a holding company or a non-financial SPV for acquisition of target company. So the InvIT can directly acquire the target company or through its non-financial SPV or through the holding company. Now, acquisition finance shall not be extended for acquisition of a non-financial target company which has one or more financial entities as subsidiaries or joint ventures. So if the acquisition finance is provided to the InvIT, it has to be taken into consideration that the target company should not have one or more than one financial entities as the subsidiaries. The target company should not have control over the financial entities, basically should not have financial entities as the subsidiaries. So acquisition finance can be provided to the InvIT. Acquisition finance can be provided by the IFE to the InvIT for the acquisition of the target company, which should not have financial entities as its subsidiaries. That is the idea. So IFE can provide the acquisition finance to the InvIT to acquire the target company that should not have financial entities as its subsidiaries. Total financing extended by the lenders for this purpose of acquisition finance shall not exceed 75% of the acquisition value. Okay? So basically, let's say that the acquisition value, first of all, how will it be decided that what is the acquisition value? For acquiring a good control over the target company, the acquisition value is decided by the independent valuers hired by the IFE. So IFE will have to hire the independent valuers. In case of listed company, in case the target company is a listed company, valuation shall be determined by one independent valuer. In case the target company is unlisted company, the lower of the valuation has to be decided by two independent valuers, and the lower of the valuation determined by the two independent valuers, that will be considered by the IFE. Okay, so IFE has to hire the independent valuers so that they can decide the acquisition value, they can calculate the acquisition value, and the IFE or the total financing, the total acquisition finance extended by the lenders for the purpose of acquisition finance shall not exceed 75% of the acquisition value. So if acquisition value is 500 crores, only 75% of that can be provided to the acquiring company. So if the acquisition finance, if the acquiring value is 100 crores, 75% of that, that means 75 crores can be provided to the acquiring company, okay, as the acquisition finance. So this is the idea. Now control may be established through a single transaction or a series of interconnected transactions, but completed within 12 months from the date of first dispersal of the acquisition finance. This is the idea. Any confusion now? This is the idea. Okay. So now you can revise through this. And I have taken a detailed session on the acquisition finance. So you can see that session if you want to know more about the acquisition finance. Okay. The important points I have laid down here, and they have been mentioned in the infographic form also, so that you can revise that the eligibility criteria for the IFE to invest, for the eligibility criteria for an IFE to provide loan to the InvIT. These are the eligibility criteria. Then we have discussed about the eligible borrower. Okay, is the acquiring company with infra finance mandate, that is a InvIT. So IFE can provide the loan to InvIT, can provide the acquisition finance to InvIT. Okay, so we have discussed all of this. Now, as per the press release that was released on June 10, 2026, the final directions are released for REITs and InvITs, and it is clearly stated that the commercial banks can extend the finance to REITs. Only the commercial banks can give the loans to REITs, while the commercial banks, small finance bank, and all India financial institutions can provide the loan to InvITs. Okay, so remember that the commercial banks can provide the finance to REITs, while the commercial bank, including the small finance bank, all India financial institution, can provide the loans to InvITs. And we have discussed this. Okay, chalo. Now this is the first question. Try to answer this question. Example of the acquisition, maybe a REIT is trying to acquire, REIT has got the acquisition finance from the commercial bank. REIT is trying to acquire the special purpose vehicle, that is a particular project of another REIT. Okay, or the InvIT that can get the acquisition finance from commercial bank, all India financial institution, because small finance bank cannot provide acquisition finance. So commercial bank, all India financial institution can provide acquisition finance to InvIT. They can take the acquisition finance to acquire the SPV, to acquire the control over the SPV that has invested in a particular investment project, infrastructure project, okay, of another InvIT. So the REIT can take the acquisition finance to acquire some SPV, to acquire some holding company, okay, of another REIT, of another entity. This is the idea. Now, the aggregate exposure of all banks to a borrowing REIT or InvIT together with its underlying SPV, its holding company, shall not exceed which of the following? This is the first question. The second question is in front of you. I hope you will be easily able to answer this question, that which of the following conditions must a REIT satisfy to be eligible for bank lending under the amended RBI direction? So there are various options, like there are 5 options, out of which you have to select the correct answer. Okay, so I hope you will be easily able to answer this question also. So these are the 2 questions that you have to answer in the comment section below, and you will get the PDF of the session in the Telegram channel. So the PDF of the session will be provided in the Telegram channel by tomorrow 12 p.m. So usually like within 24 hours, the PDF is provided in the Telegram channel. So you will get the PDF in the Telegram channel by tomorrow morning. Okay? Any question, anyone now? Okay, to prepare for RBI Grade B, kindly suggest the book to start. So Anchi sir has taken a detailed session on the books. So just type the books for RBI Grade B preparation EduTap. You will get the videos. Okay, just see the recent video. Just see the recent video. Yes, you will have to see. Anchi sir has taken a video, so in which he has informed about the ESI. For ESI, you can use Ramesh Singh. For the finance management, there are books that have been that has been suggested by Anju sir. So you have to see that session. Okay. Chalo, have a good day, everyone. Thank you everyone for joining the session. If there is any other